Welcome, everybody, to the Chinchilla Pickin' Podcast. It is October 15th, 2023 at 2:46 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined by the one and only Baron of Bonds, Brandon Beaver. Brandon, what's up?
Oh, just sick again for like the 30th time this year.
You
Upper
you are you are sick a
something.
lot, man. Yeah.
Yeah, need to. I've been taking vitamin C, so hopefully that helps.
You need to eat your vegetables and work out, exercise, and get out in the sun more often. That's usually what helps.
Put lettuce on my burgers. Does that count?
No, no, sir. I'm sorry. That doesn't count. It is 2 weeks to Halloween. In fact, I'm going to take a picture of our screens here and share it on our social media as Brandon ducks away because he doesn't want to be in it. Because, yeah, see, look, there he goes. He's ducking away. I can't even get it. I can't get it. Oh, there we go. Oh, maybe. All right. So we're going to share that because I'm in the Halloween spirit, but Brandon is not. I do want to put a plug in for everyone listening who's in the Cincinnati area. We have a number of listeners who are in town, in the same city as us. We would like to invite you, if you want to. You could join us once again every year in December. Chinchilla Pickin sponsors a team for the Jingle Bell Run that supports the Arthritis Foundation. That is something that's near and dear to my heart, and we will gladly pay for your registration. Please reach out to us though, so that we can set that up and get that done. Brandon always shows up and walks. So if you want to walk, join with Brandon. If you want to jog / run, you could run with jogs with me. So we split it up that way. That way, Brandon brings up the rear guard, and I will lead from the front. That's fast. As long as I could go from the front. Other people show up, usually pass by me, and they get like a mile ahead of me. It's only a 5K, but they're beating me by like 20 minutes. I'm like, whatever. Um, is what it is, right? Anyways, we have a great show for you guys today. Got a lot to talk about, so let's get right into it. Brandon, I almost called you Daniel. That's my brother's name. Almost called you my brother. That's not a very good sign. Brandon has a lot of stuff to bring us. So let's go over the rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You hear the live back and forth right here on the show. That way, you get to know that we really have no idea what we're talking about. We're making this all up as we go along. No, I'm just kidding. I added that in for flavor. Brandon, since you had the majority of the show here today, go ahead, man. And I prefer Coke over Pepsi.
Okay. All right. I'm actually going to get into that later in the show. Got a deep dive into Pepsi here, and I'll talk a little bit about Coke versus Pepsi and which stock I would prefer over the others. And by the way, it's a pretty close race. It's closer probably than most would expect it to be. But first of all, one of the reasons why I wanted to look into Pepsi, I wanted to talk about the health of the consumer and earnings so far this week. I love earnings season. These shows basically write themselves when earnings season shows up. Makes my job a lot easier. But banks started out, and the big banks topped analyst expectations. JP Morgan shares rising 1.5%, Wells Fargo 3.1%, Citigroup fallen 2.2%, but all three outperformed the S&P 500, which slid down 0.5%. Higher interest rates are making loans more profitable for the banks. Consumers in the economy remaining surprisingly strong, despite the Federal Reserve's rate increases. But more loans are going bad after what had been record low losses for the past couple of years. Consumers are starting to deplete coffers of extra cash that were given to them during the pandemic. Fighting in the Middle East is continuing. The war in Ukraine, rising government deficits, all adding to the uncertainty that continues to cloud the market. Go ahead, Dave.
Yeah. So, all right. First of all, let's just stop mentioning like money given to them during COVID. I mean, that's long been gone. I think that's long been gone. I don't even think we need to mention it anymore. That's just my opinion. I just wanted to insert my opinion right here in this. I believe that any extra money people have gotten is because of the rise in wages, but the rise in wages have not kept up with inflation, how inflation's been the last couple of years. And I think that people have this misconception. They're like, hey, I make $10,000-$15,000 more than I did just 3 years ago, but yet they don't understand it's actually less when you factor in inflation.
Yeah, that's true. Okay. JP Morgan went on to say this about the situation. Um, Jamie, Jamie Dimon actually said, "This is the most dangerous time the world has seen in decades." The Citigroup CEO Jane Fraser also said, "All these macro dynamics have clearly impacted client sentiment. September is always a busy month. Seeing clients, I'm struck with how consistently CEOs are less optimistic about 2024 than they were just a few months ago." Go
I
ahead.
don't know if they were optimistic a few months ago. When I'm on the earnings call a few months ago, they all said that they look for a downturn in the fourth quarter of this year, a slower holiday season, and thus it's going to affect 2024. Everybody said that. A lot of people were even calling for the Fed to start cutting at the end of 2024 because it was going to be so bad so fast. So I disagree with that statement. I think Jamie Dimon, and this is one of the few times I'm going to say this because I usually am aligned with what he says. Usually, him and I are in agreement. I know he consults me every single time, right? But usually, him and I are in agreement here. But I think he's just being hyperbolic right now, and I feel like it's too much for the more for the media and to push a cause or something rather than actual be truthful, which I hate saying that about Jamie Dimon because I like him and I like the things he has said. I just think he's really being hyperbolic right now.
Okay. So the positive side here, banks getting paid higher for interest income. The other side to this is that cost of deposits are starting to go up. JP Morgan paying 2.53% on its interest bearing deposits versus only 0.73% a year ago. Wells Fargo and Citi also paying sharply higher deposit rates. Now, for the biggest players, what we're seeing right now, paying more on deposits, that's not really hurting them. It's not really doing much, but it's doing more pressure to the regional banks because it's pressuring their profitability. Things look worse, I think, here for smaller and less diversified banks, many of which will report next week. We started out, give me just 1 second, Dave. We started out with PNC Financial Services already on Friday. This was the first big regional bank to post third quarter results. They reported on Friday that profit slipped from a year earlier. Revenue fell short of estimates here as well. The bank said that it plans to lay off about 4% of its workforce as part of cost cutting efforts. Shares also fell 2.6%, as did other regional banks. I would look at other regional banks here coming up this week and see which ones you might think could possibly outperform the others, because if other regional banks were down on PNC, now all of a sudden the sentiment for earnings is going to be lower than what it was. And if there's any surprises to the upside with any of these, it might actually make their shares pop, at least for the short term. Go ahead, Dave.
I doubt there's going to be any upside, and that's because of a lot of these regional banks still have fallout from what happened in the first quarter of this year with SVB, Signature, and on all those bank failures. The regional banks were hit hard by that. I know PNC thought they were in a great position at the time. They even talked about possibly buying up some of those positions, but as you can see, what has happened here is what I like to call the Robin Hood effect. Robinhood once again affecting the broader U.S. market with their innovative ideas and their go ahead. I don't know, the spontaneity, man. They said, you know what, we're making money. We're making 6% interest rate off of our consumers when they put money in their accounts, and we're turning around making money off of it. So let's just give 5% of it back to the Robinhood people who have a Robinhood account and have money in there. Well, they started doing that, so then everybody else had to too, because people were leaving and opening up new Robinhood accounts, or putting money back in the ones that they had kept empty, right? So then other banks started doing it. I know Fidelity right now has a 4.99%. Other banks have a 5%. I've seen it across the way. So the problem with that is, like, the smaller, like you said, the smaller regional banks can't keep up with this because they were dependent upon that to maintain some part of their positive cash flow. Not all of it, it's just a small part, but it is a part that is going to hurt their bottom line. So once again, Robinhood is affecting the whole industry as a whole because of they want to push these innovative ideas, which is great. The banking industry needs a shakeup. We have too few banks really running the innovation here. And I like Robinhood pushing forward with their innovative ideas because it forces the banks to be more nimble and not stuck in their ways. And that's why we need companies like Robinhood.
As long as it's sustainable.
Yes, as long as but like we're seeing right now, Robinhood's paying that 5% into, if you have that account that's just sitting there, it's already starting to affect the regional banks because they are dependent upon that. But like the big banks, they can withstand this. Fidelity can easily withstand it. Every time I log in my Fidelity page, before I log in, it says 4.99% for just leaving your money in here. It's pretty good interest rate for just having that. So you never would have seen that 10 years ago. Never.
And if we think that PNC is probably the best run of the regionals, then what's that mean for earnings for Fifth Third and for others?
Yeah, it doesn't look good, and I would not buy any of the regional banks like you were suggesting. Like find one that you think is actually going to beat on the earnings. I don't think you're going to be able to find one. I think they're all going to be slightly depressed. It shouldn't be a lot. It shouldn't be a huge earnings miss. I don't know how much PNC missed by. Do you have that number handy or not?
No, don't.
Okay, so I can't imagine it was a big miss. I don't actually know what they missed by, but I'll check it up as you're talking and then give it back. But I don't see huge misses here by the regionals. Maybe some of the smaller ones are really hit. Like was it KeyBank, KeyCorp? That was one that survived the SVB, but they might be on the thin ice right now.
Yeah, it's probably, and this might actually pick up again now that the Federal Reserve's back to offloading the balance sheet. Might be something that gets even worse before it gets better over the next 3 to 6 months. But I did want to look into Pepsi. Pepsi also reported earnings, huge consumer conglomerate here, and there's a lot to get into as far as the health of the consumer goes. But let's do a little deep dive into Pepsi, look at their headwinds and tailwinds and some of the things that power the growth over there. Pepsi is made up of a bunch of different brands now. Pepsi, Mountain Dew, Lay's, potato chips, Gatorade, Tropicana, 7-Up, Doritos, Quaker Foods and Snacks, Cheetos, Miranda, Ruffles, Aquafina, Tostitos, Miss Twist, Fritos, and Walker's potato chips. More than 1 billion. I want to say this is an interesting stat I found out today. More than 1 billion times a day in more than 200 countries and territories around the world, someone opens a Pepsi product. 1 billion times a day.
Yeah, that sounds about right. I eat those flaming hot Cheetos. That's my snack of choice that I need to quit in order to continue my weight loss.
Pepsi has 7 operational segments. This includes Frito-Lay North America, Quaker Foods North America, PepsiCo Beverage North America, and that's the big one. So anytime you listen to a earnings call with them, if they say PBNA, that's PepsiCo Beverages North America. They have Latin America, Europe, Africa, Middle East and South Asia, Asia Pacific, and Australia and New Zealand, and the China region. That's where everything's kind of like divided upon with their earnings reports. And going by revenue share here, Frito-Lay North America leads with 27%. Quaker Foods North America has 4%. PepsiCo Beverages North America, sorry, that's 30%. That's the one that leads. But Latin America is at 11%. Europe's 15%. Africa, Middle East, South Asia, 7%. Asia Pacific, Australia, and New Zealand, and the China region at 6%. I think those things are always very important. If you have a stock that's a conglomerate, like a global conglomerate, like Pepsi, it's always, I think, beneficial to keep those things filed away somewhere, like saved on your computer, what their revenue share is. Because if Latin America erupts into a war, or if there's more unrest in Europe or the Middle East or something like that, Pepsi takes a dive, you can go back and look and see what their revenue share out of those markets are, and if it's overreacted to that, for example, right? Like if the war in Israel continues, ramps up, and then Pepsi takes a dive because of it. And you could say, well, only 7% of their revenue comes out of Africa, the Middle East, and Asia as a share of that. Then, maybe this is a time to buy. But when it comes to the health of the consumer here, the CFO, Hugh Johnson of Pepsi, he said there's two indicators that he looks at. Number one's the convenience store channel. Typically, he says when gas prices are up and consumer incomes are stressed, you see revenue and those channels fall under stress as well. But for quarter three, they actually saw revenue up 5% in beverages and 8% in foods in the convenience channel. So not a downturn there at all. And then number two is the food service, and that's also typically a leading indicator of the consumer health. And he said it's still growing double digits. So right now, PepsiCo not really feeling the sting. He said that they have seen consumers be more picky, more selective in their price points. The interesting thing is that the small packaged goods, like, those little tiny packages of Doritos that you could pick up for lunch, those are increasing faster in sales than the larger party size, which I think is interesting. I always buy the party size stuff because it comes out to be a better price, and then also I eat more than the average person. But it comes out to be a better price if you do the addition. But he said these people, they're buying the small packaged goods now more because, the better price. Good. Dave, do you have something to say?
Yeah. So, hey, how's it going? Welcome to the show. No, I actually didn't have anything to add to this. I'm just listening to what you have to say. I agree with, looking at the share of revenue depending upon the geographic location. The convenience store that says when, incomes are depressed and price of oil goes high, they see a downturn in that. I agree. And I think that you're going to see that, and we'll come up later on in the show why when I talk about oil. Okay. So you might actually see that. So who knew that these two things were going to interact and interplay this way when both you and I were researching for the show. But if oil prices continue to stay high and gas prices stay high, you're based on what the Pepsi CEO said that the convenience stores take a hit. Do you now sell Pepsi based off knowing that?
No, because I think that when it comes down to this weight loss drug thing, I think there's been an overreaction. I think at this point in time, and I'll get into it a little bit more, with Pepsi being down almost 10% for the year, I think you could step in and start buying it. And I think that you step in right now, you go a little bit low with what you're buying. And if we go into a recession and that happens, and then you get it, into the 130s, then you buy aggressively. Go ahead.
All right, man. All right. So you had to bring up Ozempic and the Wegovy and the weight loss. And you think there's an overreaction. I think there's an overreaction in some areas, but not all. So what people are seeing, Brandon, is that these weight loss drugs are actually working. It's sustainable. There are side effects. They are rare so far. They are rare side effects. I know last week I covered, or was it a week before I covered it? And I mentioned one of the possible side effects. It is rare, so it does not happen that often at all. So people are able to lose weight, and they lose an interest for junk food. They lose an interest for bad food. They don't crave it anymore. It's gone. That craving's gone, and alcohol. So as more and more people gain access to these drugs, then yes, I'm sorry, it's going to affect Pepsi's bottom line.
You have to take it every day for the rest of your life.
Again, if you go, Brandon, here's the thing. I want you to go up to someone who's overweight at Planet Fitness and they are struggling year over year to lose weight, and you say, "Look, I'll give you a pill that you just have to pop every day for the rest of life, and you'll lose weight, and you will not crave junk food. Will you take it?" And I guarantee you, 9 out of 10 people will say yes.
And then I have to promise them it's not going to cause any respiratory problems. It's not going to cause any heart problems, because every other late weight loss fad that we've had with weight loss drugs has ended badly.
No, Ally still on the one before this, which was 10 years ago, was Ally, and Ally is still available in stores. It has not in the battle. There has been no long-term side effects of it. Plus, Ozempic and Wegovy have been around a long enough time for diabetes that we would have seen these things happen already. So what you're talking about Herbalife in the 1980s when they were using the same thing that you find in crystal meth to make you lose weight, and that's when the United States went in there and said you can't be selling this product for weight loss, and so they cut the use of epinephrine in weight loss drugs. That was what you're referring to, and there was reasons behind all that. It did work, but yet it was, causing people to have be addicted to sometimes crystal meth. So it was a bad thing. But this is something different and something new, and it is working. So you and I can butt heads about this all day long, but I do think that the more people that use these drugs to lose weight, you're going to start seeing less and less of these people buying the junk food.
What was that name of that company that you said's been around for about 10 years or more?
Ally.
Oh,
That
yeah,
was the drug. That was the drug, not the company.
They put
Ally.
Pepsi out of business.
Well, they work a
Listen,
different way. Ally works a different way than these other drugs, Ozempic and Wegovy. Ally works as more like a diuretic of pushing things through and making you. It's meant to decrease your overall appetite. Versus Wegovy and Ozempic make you decrease your appetite for junk food and alcohol.
Okay, but do you think that with less than 1% of the population in America taking Ozempic, do you think that that was a reason for a 10% slide in Pepsi?
I think people are looking. No, I don't, but not right now. But I think people are looking towards the future because a lot of Americans are obese and overweight, and what they're seeing is if this really takes off and more Americans find out about it, and more Americans realize they can gain access to these drugs, especially if you're morbidly obese, you could get your insurance to cover it. If you are obese or morbidly obese, you get your insurance to cover it. More and more Americans will start taking this. More and more Americans will start losing weight. This is what's going to happen.
Okay. We'll see. It's hopes and dreams right now, but
Denmark is loving it. Denmark is loving it. The Denmark GDP is through the roof.
Yeah, that's true. In March 2020, PepsiCo acquired Rockstar Energy for $3.85 billion, continuing to add growth to its portfolio. They also finalized the purchase of South Africa's Pioneer Foods for $1.7 billion. So kind of going all around the world still here. All around. Okay, anyways, I want to talk a little bit too about what the CEO did say about volume, because volume was actually down for Pepsi, even though revenue was up, and so is profitability. Unit transaction and consumer interaction with the brands are the metric that we're trying to maximize as we're making these trade-offs between volume, net revenue, and margin expansion. That's what the CEO said. And he said, for this quarter, the balance of the year, we feel very good about the margin expansion in PBNA, Pepsi Beverage North America. And then they also updated their 2024 guidance. They gave 2024 guidance, which was a good guidance. And the reason why Pepsi's able to do this is because they make all of their purchases 9 months in advance. So inflation, all of that stuff's already factored in what they're going to do for the next 9 months. Makes it a lot easier for them when compared to their competitors to be able to make forecasts going out for the next year. Now, we've talked about Instacart. We talked about the Instacart IPO. We were both bearish on that, and we wound up being right so far. But they wanted to talk about their investment in Instacart. He said there's a commercial relationship. They're trying to enhance the capabilities of their DSD system, which that's direct store deliveries. So I can get into this in a minute. What they're doing is they're delivering their highest selling products directly from the bottlers and from the manufacturers to the stores, completely skipping out on any warehousing. Really makes their supply chain a lot more efficient. But he said there's a commercial relationship between trying to enhance the capabilities of the DSD system with our shoppers that they have in the store, and that's a continuous focus. And he said he thinks DSD continues to be a competitive advantage, and I think that we can enhance that capability with supporting activities from Instacart shoppers. and that the commercial relationship led to a very minor investment in Instacart, and just to reinforce the commitment to commercial relationships. There's nothing more, he said, to that. In the terms of the strategic long-term intentional, what their intentions are with that investment, they're not looking to buy out Instacart or anything like that, but they're trying to use a digitization and automation to give more precision to their decision making, for example. So, for example, in FY 2022, Pepsi spent over $770 million on research and development. RD expenses ranged between $665 million and $760 million for the past 10 years. Now, that strong partnership with Instacart, what that does is it gives them more visibility into how the customer's shopping and insight on how to more effectively spend those R&D dollars. Those ads that pop up on Instacart when you're in the store, Pepsi views that as very, very beneficial for them. Now, when we're talking about the direct to the store deliveries, this is something they introduced in 2011. And this is ensuring that independent bottlers and distributors deliver the beverages, snacks, and food directly to the retail stores. This is ensuring faster restocking, better in-store promotions, maximum visibility, and such things like that. Now, Gatorade actually was just added to the DSD system, and as a result, Gatorade's earnings surprised and were higher up on the upside and drove Pepsi's earnings further than what most analysts expected. So let's go into the Q3 earnings. The company recorded third quarter earnings is $2.24 a share. This was up from $1.97 the same time last year. This beat Wall Street expectations of $2.15 a share. This is the 55th quarter in a row that they beat EPS expectations. So, we're looking at the 2024 guidance. I think you could be pretty comfortable that they're probably going to hit that as well.
Hold on. How many weeks in a row, how many quarters in a row has Apple beat?
That's a good question. I don't know.
I mean, the point I'm trying to make with this question is rhetorical. My point I'm trying to make is that when you pay off the analysts enough and they just lower their expectations so that you can always beat and always be this shining star every single quarter, that's ridiculous. At some point, we got to come in with realistic expectations. I'm not saying that that's what these companies are doing. I'm not accusing them publicly of doing that here. I'm just being Jamie Dimon hyperbolic right now, and just saying, like, look, man, at some point we gotta just up these expectations for these companies like Apple, companies like Pepsi, and say, look, you're gonna beat, so we're gonna raise them. Now beat this new mark that we just gave you, because that's what they're doing, and I think we need to set that bar a little higher for them. And that would be my call out to the public here, and we need to make that call out on CNBC.
Right. That's a positive thing for Pepsi too, that we're saying we need to raise guidance on these things and raise our estimations because they're doing so well. Go ahead.
No, I mean, you're right. Go ahead.
Yeah, revenue also surprised on the upside, coming in at $23.45 billion from $27.97 billion, $21.97 billion the same time a year ago. Analysts forecasted $23.41 billion in revenue for the third quarter. PepsiCo also upgraded its full-year earnings forecast, anticipating annual core earnings per share to rise by 13% and to hit $7.54. That's pretty good for a company that's been around for so long, for that to rise by 13%. But the previous prediction was 12% growth to reach $7.47 on earnings. The company also reiterated its full-year guidance for a 10% rise in organic revenue. Also really good for the situation that we're in economically with inflation. I think that revenue going up, of course, is that's a given, but the profitability rising and the earnings per share to rise by 13%, that's really what I'm focusing in on here. Drinks and snacks, Giant also expects its fiscal 2024 results to arrive at the upper end of its long-term outlook. And that was set at the start of the fiscal year. And organic sales, they're expecting to grow between 4% and 6%. Adjusted earnings climbing by a single-digit percentage. And as I said, they're able to give more accurate full-year guidance because they purchase their products that they're going to sell, the ingredients and such. It's bought 9 months in advance, so they already have that baked in. to what their profitability is going to be. But PepsiCo did see organic sales volume drop by 2.5%. North American drinks and Latin American convenience foods during this quarter had both fell, with the former dropping by 6%. In a bid to drive transactions, Pepsi has focused on smaller packaging and value packs. And I think that's interesting because I usually think that people buy in bulk during this time frame. That's what I do, but it appears to be the trend is otherwise. Go ahead.
Well, I mean, it could be companies that have, during the COVID pandemic, everybody had to switch to individually wrapped products for their coworkers or for vending machines and so on and so forth. And so people are more apt to go that route than to a big and bulky and everybody share a bowl that you put your hands in and you dip. You know what I mean?
Yep.
My concern was with the big union pushes around the country right now this year. And Pepsi's a non-union. It's an open shop worker. There would be a push to unionize Pepsi. I know the Teamsters are big in Coca-Cola. I wonder if that would be a concern to Pepsi at all.
I'm sure at some point, somewhere in their ecosystem, there's a union. That would be sure. But speaking of Coke, let's look at Pepsi versus Coke. Pepsi's price to earnings ratio, 27%. Coca-Cola's PE ratio is at 22%. So far, this looks like Coke is more of a value, but when you look at the growth, Pepsi's growth has outpaced Coca-Cola in the past 3 years with revenue growth rate of 9.3%.
Because they have more product line.
Yeah, so you kind of see the justification of a higher price to earnings ratio there with Pepsi. Its future 3 to 5 year total revenue growth rate's projected to be at 5.63%. But there's something that Coca-Cola has a competitive advantage here. Its free cash flow ending last year in December was at about $9.53 billion. This is 22.17% of its revenue. That means 22% of its revenue, a little bit more than 22% of its revenue is converted into free cash flow for last year. That's pretty good. Pepsi, unfortunately, here only recorded $5.6 billion in free cash flow. That's a 6.48% conversion. So just looking at those numbers as far as efficiency goes and being able to return cash back to shareholders, I would go with Coca-Cola here more on the long term, edging Pepsi out. I think both of these kind of belong in your portfolio there. I would look at kind of buying both here. I would buy both, but I would go light into them and then aggressively add into Coke. If Coke comes back down into the mid 40s, back the truck up and buy it. And if Pepsi comes down into the 130 range, back the truck up and buy it. These are two companies, Dave, that I would say, like, you know, when you go into, if we do have a recession and if we do have a recession and stocks fall hardcore, the best bets are to go with companies like Pepsi and Coke. You know, if you've got 1 billion people or, you know, opening up a Pepsi product every day, I would say it's a safe bet. Go ahead.
All right. Finally, I've had my hand raised here in our little Teams meeting or Zoom meeting here forever. Listen, man. Yeah. I mean, Pepsi's great, but like for all of us who aren't as bright and as smart as you, Brandon, can you explain what free cash flow is?
It's cash that's not assigned to anything. So it's not going to be going into any investment. It's not going to be going into a dividend. It's not paying back any debts.
So let me explain that even further for those who are listening right now who maybe are new investors. So if you're in a company and you expect to make $1, right? You expect to make $1. You're going to say 20 cents is going to pay my employees. This 20 cents over here is going to pay for all of our buildings. This 20 cents is going to pay for our oil consumption. This 20 cents is going to pay for our research and development. Basically, what you're saying is 20% of Coke's net profit or revenue is coming in, and it's not assigned to anything. They're just coming in. That's how much extra cash they're making on top of what they already have assigned. So I just want to make sure that people understand that, you know, Coke has all this extra money coming in. So they have the ability to go ahead and compete with Pepsi if they want to buy out some of these others, or maybe they want to create their own type of chips to compete with. I mean, there's all kinds of possibilities, but it's a great investment, like you said. I just want to make sure everybody understands it.
Yeah. So Coca-Cola better with efficiency. Revenue was is much higher for Pepsi. So you're kind of seeing, two sides of the same coin there. I feel like they've become like they've kind of split apart. They used to be very similar. Of course, it's Pepsi versus Coke, the soft drink, super similar. But the way that they run their companies is two different styles. That's all I got. I'm done now.
Nice. Oh my. Well, wow. You're done finally. Okay.
Well,
Well,
finally,
let's move into one thing I want to talk about real quick, and then I got a couple headlines for you, Brandon. We'll end with that. All right. So the first thing I want to talk about, and this is I'm fairly shocked. So I'm going to pay attention to this author, if you will, Tim Mullaney with CNBC. And what I'm shocked about is how good this article really is. It does leave out certain things in certain key areas, but it's a good article, and it covers a lot of different ground here. And I don't like the way he attacks his points, but he does have a lot of facts and figures behind it. And so it's a good article. The headline is U.S. oil is back, and ExxonMobil's $60 billion deal isn't even the biggest signal. So this was published today, October 15th at 10 a.m. So not too long ago, this came out, and it's a good article. If you get a moment to read it, please read it. You'll get a lot of good information here. But in it, it talks about where the U.S. oil production is coming from. And it's mainly coming from the Permian Basin in Texas. So there's a lot of things that it goes into here. What is saying, one thing it starts off with, he goes in right away and says, on October 12th, U.S. crude oil production hit an all-time high of 13.2 million barrels per day. And that wipes out the COVID-era losses. That's his first whole paragraph right there. Goes right into it. Then he talks about the Exxon deal that just happened. And it goes into where this is coming from and how they're making how they're being so productive, even though, as we point out in the show, the amount of rigs in North America has drastically dropped, right? So how are we pushing these oils per day up? In the article, if you get a chance to read it. It talks about the efficiencies that we're making with shale and efficiencies we're making in other areas. Alaskan oil is still going down. He goes into that. It goes into North Dakota, South Dakota. There's a lot of the shale areas there that they can't get reopened due to costs, and the oil companies don't want to spend the money there. In Gulf of Mexico, staying steady for right now, but the boost is coming from the Permian Basin. That area, if you don't know where Permian Basin is, it's right around Texas, New Mexico, some parts of Arizona, Colorado, that area, Permian Basin, mainly Texas and New Mexico, right? So that's where it's coming from. And it's coming from efficiencies in the market. So in it goes into how between oil lost 40% of its value between 2014 and 2019. But then so we were start pumping it out at a very inefficient way. They were just pumping out oil in order to make profit, where they were making profit, but they were doing it inefficiently. Well, then after COVID happened and oil dropped down to real lows, a lot of people made a lot of money off this. I was one of them because we bought in options on oils because we knew it was going to go back up. Oil went back up like we saw, but when it shot back up and the administration's changed, and I've covered on the show that the Biden administration came in and they drastically made it harder to start up new rigs and get new drilling sites approved, right? So these things happen. So now the oil companies have fewer drilling sites. They're still pushing to get more, but they have fewer drilling sites, but they want to make money. So they push their money into innovation and finding ways to drill, be more productive with what they already have in place. And that's what you see here. And the article is very good if you read it. It talks about it. It has a couple graphs, a couple charts. It goes in details about this and where they see it going. Basically, U.S. oil companies cut capital spending to $106 billion last year. And that's a drastic cut from $199 billion in 2014. So that's a huge cut in the amount of capital spending they're spending on. So where are they putting this extra money to? They're giving it out in dividend payments. They're giving out in stock buybacks. They're trying to increase their stocks. This is why the oil companies' stocks are going higher, which is what I've covered on the show. I was like, why are these stocks going higher, even though the amount of rigs are out there? How are they doing this? Well, this article really goes into it. I recommend reading it. Brandon, I want to get your first initial thoughts on all the information I just spewed out to you right there.
I'm still processing.
I know it was a lot, and I talk kind of fast, so I wanted to break it up there. And do you understand the point I'm trying to make here, right? And the point that the author of this article is making is that oil companies have to do more with less because of all the changes, and so they have all these billions of dollars, so they found a way to do it.
Yeah, and I mean they've really made themselves a lot more efficient. I forget who it was that said that they'd be fine at $40 a barrel.
That was BP. BP came out and said that. Yes, which is surprising that he said that. Very surprising. I mean, if you read more about this article, it said the average production per rig of new wells topped 1,000 barrels a day. So 4 years ago, that they were only able to do 668 barrels per day. So that's an efficiency jump of over 50% from where they were.
Wow.
So that's a huge jump in efficiency. So that's how come the oil stocks were going up, even though the rig count was dropping and it was harder to get new rigs up and running. They just found a way to pump more out at a more efficient manner.
Yep.
About the big merger that happened, ExxonMobil CEO Darren Woods said the company did the merger because it thinks technology and scale can raise the productivity of pioneer fields. So they got pioneer fields, they bought them out, and with basically he's saying, hey, with our new technology and bringing in our innovative ideas with pioneers acreage, land, drilling sites they own, we could get more out of it than they could. That's basically what he's coming out and saying. That's why it was a good deal for him, and it was a good deal for Pioneer on that. Given this, he does go in to say that, with the overseas, tensions, he covers that in the oil with Israel, Hamas, gas prices, with Iran going on TV recently saying that they are going to get involved if this continues. Now there's a risk to global oil production because of the area, the region that this event is happening in, the geopolitical events there. Now they're saying that the oil prices are going to stay higher and probably move a little bit higher in the short term. And they're going to stay higher because of all this. And because, the oil companies are liking it right now. I mean, at the higher rate, they can actually pump out more shale, but why? Why try to open up new sites in North Dakota where it's very expensive to get the shale out? You need to make, I believe it's like $60, $70 a barrel to make profit. Versus, some of these Permian Basin sites, they could pump it out at a much cheaper rate at $30, $40 a barrel. So they're making a lot more profit off of each barrel that comes out versus North Dakota and South Dakota regions. So there's a lot that goes into this article. Please take time to read it. It's a great article if you're interested in oil. Based off this news, would I buy an oil company? I would definitely look at ExxonMobil. Definitely, just because of I read into ExxonMobil a little bit after reading this article, and I like the direction the CEO is taking the company. I like his focus on innovation, on trying to be more agile and trying to be more productive with what you have in place, rather than just throw money at spinning and buying up land and putting in oil rigs.
Sorry, I sneezed in the background.
Any thoughts on anything oil or what I just said, and how does that affect Pepsi? Now that you know that, how do you know this about this?
Do you think oil prices are going to go up?
In the short term, yes. Oil prices are going to go up in the short term, so our price we pay at the pump is going to go up in the short term. So then, people are going to be spending less money at convenience store and buying Pepsi products.
Okay. So, what oil company would you be specifically targeting right now?
ExxonMobil.
Exxon. Okay.
ExxonMobil.
Okay.
Yeah, and again, I would stay away from rig. I would stay away from Schlumberger. I would focus strictly on the oil companies themselves. Maybe look at a ConocoPhillips or a BP, but not the ones that survive off of the oil companies.
Right, right, because they're going to be servicing the rigs, which there's going to be less of.
Exactly. There's going to be fewer rigs because the oil companies need fewer rigs now. They just found better ways to do it.
Okay, gotcha.
Cool. All right, man. Let's move in. You ready for these articles?
Yeah.
All right. And of course, this is the moment every single time. It never fails. I say, "Are you ready for articles?" And then, boom, my internet just freezes. This is just
Yeah.
fantastic.
Your internet freezing. I'm sneezing and coughing in the background nasally.
It just, you can tell we are not professionals in the least about this. I do know one of these articles right off the top of my head, so I don't need to wait for my computer here, my laptop to catch up. We're going to go ahead and talk about the Fed rate decision. The Philadelphia member of the board came out and recently said that they don't see a need for the Fed to raise rates. Again, everybody was expecting another 25 basis points increase. I believe that they came out and they said that, hey, we could kind of stay right where we're at. We don't need to raise these rates. That should be good news in the market, except that I believe they are wrong. I don't believe they actually hold the whole FOMC in agreement on this. And this is the article finally popped up here on my screen. The article title is FOMC likely in position to hold rates where they are, quote unquote, Philadelphia Fed Harker says. In it says that they're going to stay right there at the 5.25. They're not going to go up any higher. I disagree. I believe they are going to go up higher just because Jerome Powell has came out on TV and said many, many times that the 2% inflation rate is where they want to head, and he's staunch at heading that goal. He is, he's dug in a trench and he said, no, we're going to hit this goal. We're going to do it. We're going to get there. And so I believe Philadelphia Harker is incorrect. Thoughts,
Yeah,
Brandon?
I do too. I honestly think he should be right at this point. Now, rewind 12 months ago, me and you were both as hawkish as we could possibly be. But now, given the fact that we've interest rates have risen so far, so quickly, at a pace that's historical, the highest rate increase in this period of time in the history of the United States. Let's give it a little bit more time and see what kind of effects we've actually had on the economy. Maybe even 3 more months, maybe even, a couple more Fed meetings, and then just wait, see what information comes out by that, because a lot of these interest rate hikes that we've had really haven't completely filtered through the system yet. So that's where I would land on it. And if we're going to get inflation back down to 2%, let's do it over the course of a few years, not over the course of 12 months.
I agree with some of what you're saying there. I agree with some of what you're saying. I do believe that, Jerome Powell wants to make a difference and wants to get us to 2% and get inflation under control. His problem is that every single month, the inflation report comes out, the jobs numbers are through the roof. But then again, it's just people coming back into the workforce. We covered this on the last show. It's not actually, people, new hires. It's people who went to like gig jobs or somewhere else, or just didn't want to work during COVID. They're coming back to the workforce. They're taking up all these jobs that they would have passed on 2 years ago, and now they're being forced to take them. So given these hot job numbers, given that inflation is just holding steady right where it's at, no matter how many basis points they hike, I firmly believe that the Federal Reserve is going to continue to hike. They're going to stick with that 25 basis points. I don't believe we should trade based off of Philadelphia Fed Harker's comments here. I believe stick with the 25 basis point decision, but at the end of the year, we're going to see that it's going to raise it up some more. And then when the college tuition repayments start, I think that's going to have the effect that Jerome Powell's looking for.
Yeah, so do I.
So there you go. That's that article. And then we're switching over here again. I have no idea why everything is moving so slow right now, man. It's just, it's just one of those days. It really is. This one is about something I enjoy, something I have thoroughly enjoyed since I was a kid. and it's about football or soccer if you're American, football or soccer if you're American, and it has to do with Manchester United. This one came out yesterday around 11:40 p.m. It is Qatar's Sheikh Jassim refuses to raise $6 billion for a Manchester United bid because the team was being put up for sale. Manchester United is publicly traded on the stock exchanges. If you did not know, you can buy stock of Manchester United. I went to Old Stratford as a kid. I have a scarf from Manchester United. So I have been a fan since the early 90s. Basically, it moves, and now there's just one bidder left for this, and this is Eno's chair, Jim Ratcliffe, and he's only going to buy a 25% stake in the club. So it's going to allow the Glaziers, the family that currently owns it, to cash out some of their stake, but they still own most of Man U. And he's coming in with a higher valuation than the $6 billion valuation of Yassim. My thing with this is we are basically saying that Manchester United is worth more than $6 billion, and it's just a soccer club or a football club. And some people are like, just a football club or just a. I'm like, yeah, over $6 billion for this. And it is now getting, I mean, you talk about inflation. Talk about inflation. I think 20 years ago, you probably could have bought Man U for barely a billion, probably like what, 800 million, something like that, 600 million. And now we're talking about over $6 billion.
The market's currently valuing it at 3.26 billion.
Yes. Yeah. That's it. Yeah. If you go into this article, read it. That's what it says as well. And just to give you some comparison, we've all heard of the Chelsea Football Club, right? Another highly successful club that was bought for 3.1 billion. So this one is, they're saying it's worth over 2 times what Chelsea is worth. The Man U crowd is very big and diverse around the world. There's a huge following of Man U, but I just, wow, where does this end with sports money and entertainment, man?
I don't know. I don't know much about soccer, but that's a pretty high valuation for it. And granted, it's the most popular sport in the world. It fills out stadiums everywhere, other than the United States. But maybe
Yeah.
there's potential there for it to possibly be someday, worth $6 billion. But at that point, he's just breaking even.
Well, what it says here, if you go read the article, and near the end of it, it says that Manchester United has over 600 million fans worldwide, according to market research firm Kantar. That is outrageous. That many fans.
Yeah.
Outrageous. Oh man. Craziness. All right, Brandon, those are the headlines I have for you, man. Any final thoughts?
I wonder what their potential for, or what they see the potential for merchandise sales are. Because I mean, it's not like if you go to any sporting goods store here in Ohio, you're probably not going to find any Manchester U stuff, or if you do, it'll be very, very small section of it. That's it.
Yeah, if you go like so Cincinnati, Ohio, where we live, very Midwest town, you will find a Man U T-shirt or some sort of jersey in a with Dick's Sporting Goods store. You will be able to go into it and find one, maybe two. But you have to understand, we're in the middle of Ohio, and you're able to walk into a sporting goods store and find 1 or 2 T-shirts about a football team in Great Britain. So I think that is actually shows the impact of Man U. But is it worth over $6 billion, man? I don't know.
I don't know either. Look at the
Crazy.
Cowboys. I think they're like 20 billion.
The Cowboys are like 1 million. Come on now, man. They're not worth that much. Their fans are weak. Come on.
Come on. Yeah, we're global. We're global. We're just as big as Man U. Listen, I spent a couple months in South Korea about 10 years ago, and I ran into 2 different people with Cowboys jerseys on in South Korea.
Well, I don't know what to say to that. I'm sorry for them. Brandon, final thoughts, man. What do you got?
It's been a terrible 25 years for me being a Cowboys fan, but I just still love stick to it. I can't, I know nothing else in life other than that and stocks, and that's it. I really am still concerned about a recession. I think all of these uncertainties still remain, and I just think it's taken longer to get there than what we initially expected. That's my final thought. Once it comes, if stocks dive, go for it.
Gotcha.
Take
Here's my final thought. I looked at PNC while you were talking there for a little bit. Because I don't pay attention while you talk. Duh, why would I do that? So I looked at PNC and their earnings. They actually beat on earnings, and it was their bottom line beat, top line missed by very little. It was more of their new loans and repayment on loans fell, and so the guidance was kind of iffish, and that's why you saw the drop in stock price. Just FYI, so they did beat on earnings. So they are profitable. They are still making money. And that is considered, yes, one of the better regional banks in America.
Low bar. That's a low bar. They're making some money.
Well, that is a low bar. Yeah, it is. It is definitely not like Pepsi where we need to raise the bar. I will give you that. Yeah. So, my thought is, I still am buying Tesla, and I like Tesla. I know people have criticized saying, "Hey, I saw a Tesla ad the other day. Tesla's having to advertise now." Because they've really never spent too much money on advertisement ever. It's just Tesla, it, you want to buy it. And it's they're signaling that they acknowledge the competition from other car companies on EV market, but even with that competition, nobody can build a EV car cheaper than Tesla. Tesla is still going to be able to build it cheaper, which means their profit margin is going to be higher. So if GM and Ford or Stellantis want to go out there and build a car, they have to charge a whole lot more in order to make money to pay for those unions. And Tesla can just build it a lot cheaper and be a lot more profitable, which is what's going to help them. The problem why the stock took a hit last week was due to the China news, how it was a 10% in sales decline in China. Which is a huge decline, and China is a huge market. But I still believe Tesla to be strong and innovative for the future. I completely love the AI aspect of how it's going to make their computing faster, better for the EV/EV cars, and how it's going to be more efficient and cheaper because of that. And so that's the belief. I loved when that headline came out, and I read into it, and I read into the actual articles on it. Look it up if you want to. Tesla is going to be going places. I don't think you're going to see much movement over the next few months, but you will eventually. And so this is a long-term investment play. So you could buy in like I am, a little bit each week, and then see where it goes.
I agree.
All right, guys. As always, that we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.